Thanks for joining our discussion on gas pipeline infrastructure. The number of projects calling it quits has been increasing, and the future for new build projects seems less promising. Warren, why are projects being shelved?
The review and approval process that has become highly scrutinized. Opposition groups are becoming better organized, better funded, and laying legal challenges every step of the way. This was successful on July 5th with the cancellation of Atlantic Coast Pipeline, would have gone from West Virginia to North Carolina. That project was already delayed 3.5 years and cost up to $8 billion prior to cancellation. Simply put, litigation costs, delays, increasing cost uncertainty, that threatens the economic viability for all pipeline projects.
Nikolai, what degree of cost escalation and timing delays are we talking about? Can you give us an idea?
Sure, Matt, very serious ones. We looked across the 10 biggest Appalachian takeaway projects that have come online since 2015, and we found out that their cumulative cost overruns were close to $5.1 billion. And also, projects are taking much longer to come into service. We estimate currently over a year more than the originally scheduled in service date.
Warren, speaking of Appalachia, what's going on there currently, and what's the infrastructure impact look like from the short term to the long term?
Well, following the oil price downturn earlier this year, expectations for associated gas from oil driven plays, well, those diminished. Offsetting that loss is a production call for low cost dry gas plays like the Marcellus and Utica. And this is warranted in the coming years. However, keep in mind that there is a finite amount of spare takeaway pipeline capacity from the region, limited demand growth. So that creates a ceiling to where Appalachia production can grow into. Assuming no major interstate pipeline projects are built after Mountain Valley Pipeline, we believe market constraints could emerge by the year 2022. Appalachian production could be capped to 36 to 38 billion cubic feet per day, which is only 4 to 6 billion cubic feet a day above current levels.
Sounds like gas infrastructure potential is less promising. For projects that do need move forward, they're going to need a higher risk adjusted rate of return. Pipeline opponents are getting even more traction. So we may not see a big impact on the cost of supply until post 2022. But beyond that, we certainly could see sustained higher gas prices. Thanks for joining us.